Steve is driving home on a Tuesday. He blacks out, hits a guardrail, and dies instantly. It's tragic, but his wife, Linda, thinks she has a safety net. She remembers the policy Steve paid for faithfully for a decade, $100 grand for accidental death. She files the claim. She waits. 2 weeks later, she gets a letter. It says denied. Why? Because the autopsy showed a heart attack caused Steve to lose consciousness. The insurance company argues the heart attack, a bodily malfunction, caused the death, not the crash. They say the wreck was just a symptom. So despite the mangled car and the police report, Linda gets zero. Absolutely nothing. That is not a clerical error. That is a feature of the product. And that is exactly the kind of junk insurance we are tearing apart today. I'm Mike. I spent years working inside the insurance industry, in the back rooms where they design these policies and write the scripts to sell them to you. I've seen the math, and I've seen how the sausage is made. And let me tell you, it is not designed to be nutritious. It's designed to be profitable. Today, I'm walking you through the 7 insurance policies that are, for all intents and purposes, a total scam. Now, I don't use the word scam lightly. These products are legal. The contracts are binding. But they are scams because the math is so aggressively stacked against you that you might as well flush your money down the toilet. Think of it this way. Imagine you go to a hardware store to buy a drill, but the salesman steers you toward a special edition drill. It costs twice as much, but it only works on Thursdays and only if you're drilling into pine wood and only if the temperature is below 70 degrees. If you try to use it on oak, it shuts off. If you use it on a Friday, it breaks. That is what these niche insurance policies are. They sell you the feeling of safety, but the actual trigger to get paid is so narrow it's almost impossible to hit. Let's start with the first one, the one that ruined Linda in our opening story, accidental death and dismemberment, or AD&D. You see these offers everywhere. They come with your credit card statements or from your bank. You've been pre-approved for $100,000 of coverage for just $9 a month. It sounds like a steal, but here's the reality. You are statistically very unlikely to die by accident. Most of us die from health issues, heart disease, cancer, stroke. AD&D pays absolutely nothing for those. It's a lottery ticket where the prize is your own gruesome, specific death. If you have a real life insurance policy, term life, you are already covered for accidents. Term life pays if you die in a crash or if you die in your sleep. AD&D is just a way for insurers to collect premiums on a bet they know they will almost never lose. Number 2. Flight insurance. You're booking a ticket online and a little pop-up warns you, protect your trip for $25. Listen to me. Commercial aviation is the safest mode of transport in human history. You're more likely to die driving to the airport than you are on that plane. But let's say the unthinkable happens. The airline has massive liability coverage. Your credit card probably has travel protection built in. Your regular life insurance covers you. Buying a separate policy just for the 6 hours you're in the air is pure emotional manipulation. They are monetizing your fear of flying, not a real financial risk. Number 3 is the one that gets everyone at the counter, the rental car damage waiver. I know. The agent at the desk makes you feel irresponsible if you don't take it. They say, if you scratch it, you pay for it. But before you panic, pull out your phone and call your own auto insurance agent. Ask one question. Does my comprehensive and collision coverage extend to a rental car? For the vast majority of you, the answer is yes. If you have full coverage on your own car, you have coverage on the rental. And if you pay with a decent credit card, that card often provides secondary coverage for the deductible. The rental companies charge you $30 a day for this. That's $900 a month. Would you pay $900 a month to insure your Honda Civic at home? Of course not. It's a duplicate tax on your anxiety. Number 4 makes my blood boil. Children's whole life insurance. You've seen the ads. Cute baby, soft lighting, a deep voice saying, give them a head start. Here's the cold, hard truth. The purpose of life insurance is income replacement. If you die, your kids starve because your paycheck is gone. Your baby does not have a paycheck. Your baby has no financial dependence. The only reason to insure a child is to cover funeral costs, which is a dark thought, but you can usually add a rider to your own policy for that for a few dollars a year. The investment angle they pitch, it's terrible. The fees in these policies eat up the cash value. If you put that same monthly premium into a 529 college savings plan, your kid will be infinitely better off. Do not lock your money into a low-yield prison for 20 years because of a cute commercial. Number 5, extended warranties on electronics. You buy a TV, a fridge, or a laptop. The cashier asks, do you want the 3-year protection plan? No, you do not. The math here is brutal. The cost of the warranty is often 20% of the item's purchase price. We have something in engineering called the bathtub curve. It means products usually break immediately, which is covered by the manufacturer's warranty, or they break way later when they're old and you want a new one anyway. That middle period, that's the profit zone for the insurer. If you take all the money you would spend on extended warranties over your lifetime and put it in a jar, you could self-insure everything in your house and still have money left over for a vacation. Number 6, credit life insurance. This is the stuff lenders try to slap onto your mortgage or car loan. If you die, we pay off the remaining balance. It sounds noble. It isn't. It is vastly overpriced compared to regular term life. And here's the kicker. As you pay down your loan, the payout decreases, but your premium stays the same. You are paying the same amount of money for less coverage every single month. And the beneficiary isn't your family, it's the bank. Just get a term life policy. It's cheaper, the payout stays level, and your family controls the cash. Finally, number 7, disease-specific insurance. Cancer insurance, heart attack insurance, stroke insurance. This is marketing genius and financial stupidity. Why would you want a policy that only pays if you get one specific thing? What if you get hit by a bus? What if you get MS? What if you get a different disease? You need comprehensive health insurance and a good disability policy. company. I want to dig into the fine print on one of these cancer policies, because the devil is in the details. I have a clause here from a real policy. I want you to listen to this language. Benefits are payable only for the actual treatment of cancer as defined herein. Pathological proof of malignancy must be provided. Carcinoma in situ and non-invasive tumors are specifically excluded. Did you catch that? Carcinoma in situ. That means cancer that hasn't spread yet. So imagine this scenario. You go to the doctor for a checkup. You're proactive. They find a cancerous growth early, you rush into surgery, get it removed, and save your own life. You file a claim. The insurance company looks at the pathology report and says, sorry, you caught it too early. It wasn't invasive enough. Claim denied. You are effectively punished for being healthy and proactive. These policies rely on the fact that you hear the word cancer and get scared, but they write the contract so that they only pay in the worst case scenarios. Let's look at the tale of two clients to show you how this plays out in the real world. Let's call them Client A and Client B. Client A was a guy named Mark. Mark was terrified of cancer because his dad had it. He bought a cancer protection plan for $85 a month. He felt safe. 10 years later, Mark started having tremors. It was Parkinson's disease. He couldn't work. He needed expensive home care. He called his insurance company. They asked, is it cancer? He said, no, it's Parkinson's. They said, sorry. Mark had spent over $10,000 in premiums for a policy that was useless because he got the wrong sickness. He drained his savings and almost lost his house. Now look at Client B, Sarah. Sarah was also worried about getting sick, but she didn't buy a niche policy. She took that same $85 a month and upgraded her long-term disability insurance. When she got sick, it was an autoimmune issue, completely unexpected. Her disability insurance didn't care what the name of the disease was. It just cared that she couldn't work. It kicked in and replaced 60% of her income until she recovered. Sarah kept her house. She kept her dignity. That is the difference. Mark bought a product based on fear. Sarah bought a plan based on finance. So, how do you protect yourselves? I'm going to give you an insider tip, a weapon you can use the next time an agent tries to sell you one of these niche policies. It's a single question, but it usually makes them stutter. Ask them, can you show me the loss ratio for this specific product? The loss ratio is the percentage of premiums the company actually pays out in claims. For good, necessary products like regular health insurance or auto insurance, the loss ratio is high, usually 80%. That means for every dollar they take in, 80 cents goes back to helping people. For these scam policies, the loss ratios are 30%, 20%, sometimes even lower. That means for every dollar you give them, they keep 70 or 80 cents for profit, commissions, and marketing. They're keeping the vast majority of the money because they know they rarely have to pay out. If the agent won't tell you the loss ratio, or if they try to change the subject, that is your giant flashing neon sign to walk away. Insurance is supposed to be a shield. It is supposed to protect you from catastrophic events that would wipe you out financially. It is not supposed to be a subscription service for every minor anxiety you have. Stop buying policies that protect the bank. Stop buying policies that protect the airline. Stop buying policies that rely on you dying in a very specific, unlikely way. Here's what I want you to do right now. Go check your bank statements. Look for those small recurring charges, $14.99, $9.50. If you see accidental death, credit shield, or protection plan, cancel them today. Take that money and put it into your own emergency fund, or use it to upgrade your main term life policy. Be your own insurer for the small stuff, and only pay the big companies for the big stuff. Before we wrap this up, if I just saved you some money, do me a favor and hit that subscribe button. I'm dropping new insider secrets every week to help you beat these guys at their own